Okay, so question number 2. You are required to write an email to the client in which you are required to explain what the capital gains tax consequences will be in respect of the property which has been disposed. You are required to inform the client of how any calculations will be performed. This is also again something, unless they specifically tell you to not do it, you should always do that. Okay, so you have to write an email. So guys, all that means is you just have to show them the format. So 2, in this case, the client was called Angel, I think. Angel Mafetsa. Make sure that you get the client name correct. I know it sounds silly, but that's something that they actually pay attention to, especially when you're writing your psych exams. From CTA student, and the subject, in this case, you can CGT implications, anything like that would be fine. Start with some form of email. Dear Angel, please refer to the answer to your queries below. I know this sounds silly, guys, but that's a mark or 2. And if you don't do it, especially when you're doing psycho exams, it will count negatively towards you. So just get into the habit of it, just play the game. Like I always say also, if they actually tell you to go outside or they tell you to write it in stone, then go outside, find a rock and a chisel and start knocking it out. Do whatever they tell you to do. Okay, so let's have a discussion. So what I'm actually going to start, let me start by doing this. I'm going to do it quickly, say something or show you in the form of a calculation. So when we do answer these questions usually in a calculation, we do the following: description, calculation, / explanation. You would have seen this from all of the examples, lecture examples, and other questions that you've done. You basically do this. Now whenever there's a capital gain or disposal of an asset, we do a calculation. We say proceeds. We calculate base cost. And that calculates a capital gain. Right, that amount goes into CGT. And we do that for disposal 1, 2, 3, 4, etc. Sometimes it's a capital gain, sometimes it's a capital loss, etc. So the first thing is, you will mention this. How do we calculate a capital gain? Capital gain is calculated by deducting the base cost from the proceeds. That'll be a mark for you. Then we explain this process. To calculate the taxable capital gain, remember the taxable capital gain is the one that goes into your rand. You add up all of your capital gains and losses. From that, you deduct your annual exclusion, because this is a natural person. That gives us, remember, the term aggregate capital gain. Now, you can go and find this in paragraph 6 of the H schedule. I'm just giving that as a reference. It then tells you to bring any capital loss brought forward from the previous year and to deduct that. And that gives you your net capital gain. Alright, that's what paragraph 8 tells us. And then we have our inclusion rate. Which gives us our taxable capital gain. That is the amount that goes into our rands column. Paragraph 10 tells us that. So you will, unless they specifically tell you to not talk about it, you will talk about this. So I'm going to just quickly show you. If I take you to the solution, that's the first thing that we talk about here. A capital gain is calculated as proceeds less base cost. Paragraph 3 tells us that. To calculate the taxable capital gain, you add up all of your capital gains and losses. You deduct the annual exclusion. That gives us the aggregate capital gain. You'll deduct any capital loss from the prior year. This sentence, if there was no capital loss in the question, you could leave that out. That should be fine. And then you say the inclusion rate, you give the inclusion rate, gives us the taxable capital gain. That is just putting in words that calculation. And go and see, guys, you'll see when they're asking generally these type of things to discuss big capital gains tax questions where it counts a lot of marks like this one, 20 marks, there's always a mark or two for that. Okay, so I want you to understand that is what we do. We take this calculation that we perform and we explain it in words. That's part of the thing about doing discussion questions. That's why if you really know your work and you've done a lot of questions and you're happy with those calculations, you can get the marks. You just have to explain it. Okay, so let's talk a little bit more. When is the CGT? And I'm going to remind you, we specifically have to address this because if you go and look at the question that the client asks, she says, I'm not sure when there will be capital gains tax. And is it only for companies or for business assets? You have to address these things. So when is there CGT? Paragraph 2 tells us for a resident, it's a disposal of any asset. That resident is companies, close corporations, trusts, natural persons. So you tell the client that because you're saying to them, yes, Angel, you will be subject to CGT because you're a natural person. It does apply to natural persons, companies, CCs, and trusts. You're a resident and it's when you dispose of any asset. Paragraph 2 tells us that. So that's what you'll tell your client because they want to know that you're not just, how do they know, why is this the case? Because you're giving them a reference date, even to the act. Right. Even if you just said, guys, the H schedule says that, that would be fine. Okay. Then you can say there's no CGT on personal use assets. However, there are certain assets which are excluded from being personal use. Immovable property, and that's what we have in this case, in this situation. Immovable property is excluded. So thus, you must calculate CGT. These are all just general if you think about it. Put yourself in the shoes. A lot of you are currently working. If a person had to come and ask you these type of questions, and you had to give them an answer, that's what you would tell them. You would say, yes, you have to calculate CGT because you dispose of an asset. And I know you think it's personal use assets because you say it's the place that you stayed in and so on, but it's not a personal use asset because they tell us in paragraph 53 that immovable property is excluded. Just think about it, guys. That's exactly what you would do if you had to speak to a client. Same works for the exam. They want to know that you have that ability. Okay, so let's go and talk about all of these places. So the first one is the house in Alberton. Now what I'm going to do again, guys, because you have all of the written solution there, I'm going to do it in the form of a calculation because I think we're more comfortable with that. And then I'm going to just show you how that calculation that we perform is all contained in the discussion question. So if we go to the house in Alberton, let's think about it quickly. It was purchased on the 1st of October 2002 for 1.8 million. Transfer duty of 45,000 rands was paid. She stayed there from the 1st of October 2002 until the 1st of June 2021, but it was only sold, you'll remember, on the 1st of January 2022. Okay, so what I want you to see is the 1st of October 2002 to 1 Jan 2022 is 19 years and 3 months. So 19 years times 12 plus 3 gives us 231 months. Okay, you'll see in a second what I'm talking about there. The house was sold for 2.4 million rand. She paid the estate agent 2%. She used the house 10% of the time from the period 1 December 2008 to 1 December 2010 for business purposes. There was a bathroom added to the house. There were some repairs. Okay, so let's go and calculate the CGT. How would you calculate it if this was a calculation question? You would say the proceeds is what? 2.4 million rands. Because that's what it was sold for. Would you deduct this commission from the proceeds? No. Why not? Because it gets added to the base cost. So if you felt like you had to deduct it, guys, there's a gap in your knowledge there. Okay, proceeds. Let's do the base cost. So the base cost is the cost. The cost was 1.8 million. The transfer duty forms part of that cost, 45,000. There was improvements, and the improvement is that bathroom of 65,000. They tell us about repairs in there, and we know repairs are not allowed. Paragraph 22 tells us that. And then there was the agent commission, which was 2.4 million times, I think it was 2%, yeah. So it gave us 48,000. Okay. That gives us a capital gain. $442. Now, we use this house as a primary residence. But first, we have to take out the business portion, because that business use is not primary residence. So what was the business use? The business use was for the period 1 December 2008 to 1 December 2018. So that is 24 months, which is 2 years. And we had it for a total of 231 months. Okay, so business portion is that capital gain times 24 over 231, and it was 10% of that. $4,592. Now, if this was my CGT column, my rands column, that 4,592 would immediately go into the CGT column because we are getting taxed on it. Okay. Now, this 437,408 is everything else. This is the capital gain on the primary residence. Now, I'm just going to remind you that there was this period from the 1st of June 2021 when we moved out to the 1st of January 2022. That's 7 months when it stood empty. Okay, so we didn't use it for 7 months as a primary residence. So usually those 7 months, you would now have to remove the period not used. The same as what we did with that business portion here. So you would basically have to say 437,408 times 7 over 231 to take that out. Okay, but what is the problem? Why aren't we doing this? Again, because paragraph 48 tells us that because the property was we were trying to sell it, we can ignore this issue of removing it. So that's why we're not doing it. So I'm just going to write here, paragraph 48 applies. Okay, so this whole 437408 is treated as a primary residence. So we then get a primary residence exclusion, which is given to us in paragraph 45, which is limited to 2 million rands per primary residence. Now again, if you wanted to say here 2 million times some sort of percentage, that 231 minus 24, something like 207 or 231, or any apportionment, any type of apportionment here, you are wrong. You've already done the apportionment over here. The 2 million is per primary residence capital gain. So you get that full primary residence capital gain there. Right, so you could get the whole 2 million there, but obviously you don't create a negative amount here. So basically what we just say is up to 2 million is available. So that means the full 437,408 is not taxable and there's no further capital gain. So let's go and see it in the solution. So the house. So first up, the house is private purposes, but it's immovable property, so it cannot be a personal use asset. You say what the proceeds will be, 2.4 million rands. You say what the base cost is, the cost of buying, selling, improving the asset. Repairs may not be added. Then you do a calculation of the base cost, like we did. You could also have expressed it in this way and say, this is how the base cost would be calculated. Right, you say what the capital gain will be. It's not always marks for that, because that's obviously just the proceeds less the base cost, and you already got a mark for proceeds, you already got a mark for base cost. Right, you explain the fact that the house was used for business purposes, and that is subject to CGT. So you do the calculation, which is what we did there. And you then explain that paragraph 48 is applicable because you were trying to sell it, and that the 2 million is per primary residence. So even if you had missed paragraph 48, guys, you can see there's more marks available. So you would have still been able to score 100%, even though if you missed out on paragraph 48. Okay, lots of marks available. And this usually is the case with those type of big questions like that. Okay, then flat number 1. So flat number 1 was the one that we inherited from our husband, and we then donated it to our sister. First donation made. Now remember, this question also specifically to do CGT, but you need to remember that when there's a donation, you must do paragraph 22. Paragraph 22 says M minus A over M times D. M is the market value, A is the base cost, and D is the donations tax. So somewhere you have to know what that donations tax is. Okay, so let's do it. So here we go. This is flat number 1. The first thing I would do as a calculation is a calculation of the donations tax. Now the donations tax would be what it was donated for. It was donated for $9.50 because that was the market value at the time. You have that annual exclusion, or per section 56(2)(b. This is just a bit of a reminder of that, of 100,000 rands that you get every year. So that means 850,000 rands was the donation times donation, the 20% donations tax ratio. That gives us 170,000 rands as donations tax. Now remember again, it must be paid by the end of the next month. And also, a couple of things I just want you to make sure that 100,000 rands is deducted from the market value. It's not deducted from this 170,000 or the donations tax amount. So just make sure that you don't catch yourself out there. Okay. Then we now donate this. So this is now the donation of flat 1. So what is the proceeds? The proceeds is determined per paragraph 38, which says that we must use the market value. So it was 950. What is the base cost? Now in this case, the base cost you inherited from your spouse. So it's your spouse's base cost. And that's per section 9HA2 that tells us that. Okay, so the spouse's base cost was 1.1 million rands. You then have to add paragraph 22. So let me just a little bit further down here do the paragraph 22 calculation. So paragraph 22 again is M minus A over M times D. M is the market value, 950,000. A is everything else that is in base cost already, which is that 1.1 million, over the market value times the donations tax. The donations tax is 170,000. Now, the fact that over here we say 950 minus 1.1, that creates a negative amount. If it is a negative amount, paragraph 21 is just considered null because of that negativity. So, in other words, because A is greater than M, paragraph 22 equals null. So if you said because the base cost exceeds the market value, it's null, that would have been fine. So paragraph 22 is null. Don't see that too often, guys. So be aware of it. So our base cost is 1.1 million rands. Our proceeds was 950. So this gives us a capital loss. 950 minus 1.1 gives us a capital loss of 150,000 rands. But now, remember, we donated this to our sister, which is a connected person. So, paragraph 39 says you cannot claim a capital loss to a connected person. So you would say that. So usually what we want to do, if this is now a CTT column, we want to put that 150,000 rands there. We now are not allowed to do it, so it must just be null. Why? Because paragraph 39 says cannot claim capital loss to a connected person. Next year or the year or whenever in future, if we make a capital gain to that connected person, then you can knock that 150,000 rands off against the capital gain. They call this a clocked loss. Commonly, if you don't use that term, guys, perfectly fine. I said it's more of what's something they call it. So let's go and see the solution to this. So here's the donations tax discussion. Again, we're doing that for paragraph 22. Okay, 1 mark. That's why it doesn't count a lot in this case. You have to talk about the fact that this is a disposal because this is a donation. The proceeds per paragraph 38 is the market value of 950. You have to talk about how you determine the base cost. Remember this base cost here, your spouse's base cost. Here's the paragraph 22 calculation. It's a negative amount, so it's a null. So you calculate a capital loss of 150,000, which is what you see there. And then we talk about paragraph 39 to score that mark. So again, if you know your calculations, you can see you're just putting it into words. If you don't know those rules though, guys, and it's straight up, you just have to study the rules. If you don't know them, there's no understanding or anything like that. You either studied that rule or you didn't study that rule. Okay, then we have this number 3, the vacant plot of land. So you received a donation from your mother in 2006 when the land had a market value of 900,000 rands. You then sell it for 500,000 rands to a developer with the understanding that in future when the developer makes money, you'll get an extra 10%. Okay, so let's see how we would do the calculation. And again, this type of question was featured in ITC a couple of years ago, Psychos ITC. So this is the plot of land. So again, what would we do? We'd say proceeds. How much is the proceeds? Is what you are selling it for, 500,000. We don't know what the future amounts can be. It hasn't accrued to us yet because there hasn't been a sale. There might never be a sale. So 500,000. What is the base cost? The base cost is the market value on the date of donation. And again, so that's at 900,000. If they said, my husband, my spouse donated it to me, then you would have used the 700,000. That's that section 9HB rule. Okay, above we say section 9HA. That's because the person passed away. That's why section 9HA. Section 9HB is if it was just a normal donation. So I'm just reminding you, that's the little trick here about spouse versus not spouse that you need to be aware of. So that's at 900,000. Okay, so that's it. So the base cost, is 900,000. So you make a 400,000 rands capital loss. Now again, if this is my CDT column, I want to go and put it in there. But now I'm not allowed to. Why? Because paragraph 39, capital A says, you cannot claim a capital loss if there are unaccrued amounts. Can only claim it in future against the future accruals, or it's not even necessary to write this, I'm just explaining it now. Or if you know that you're not going to receive, if you know for a fact, so let's say this developer goes bankrupt, and you know for a fact you're not going to receive any further money, then you can claim it. Otherwise, let's say, so this is the 400,000, let's say now next year, so year 2, the developer now gives you an extra million rands for this. Then you can knock that 400,000 rands off against that million and only have the 600,000. Even if the developer next year only gives you, let's say 300,000, that's the final amount. So then there's 100,000 rands loss. Then you can claim it. But you must not be in a position where you're going to receive money in future. You can't claim a loss this year and next year have a different, have a gain on it. That's just the rule. So please, guys, go and look at paragraph 39A again if you can't remember that. Okay, again, let's quickly go and see the solution. So when the property is sold, the 500,000 is your proceeds. The market value is the 900,000 when you got it from your mother. So it's a 400,000 capital loss, and you just state that you can't claim it. So you can see it's really whatever you did in the calculation, just doing it in a discussion. And when you're looking at solutions from other places and so forth, sometimes it might feel to you like it's not as clear, but that is exactly what you still do. If you follow this approach that I've said there, you should get your marks. So think about what would you have done in a calculation, and then just explain that. Say basically just in words instead of in numbers what you would have done. And you should score definitely enough marks to pass, and you will do quite well also if you would have been able to do the calculation well. There's no reason why you shouldn't be able to do the discussion well and pass it. Right, guys, that's it for this mock test. Hope it went well.